Picture this. You've been renting for 3 years, saving carefully, watching the news for one headline. The Fed cuts rates. And then it happens, the Fed cuts. You open your banking app the next morning, half expecting your mortgage pre-approval to come back with a smaller number attached to it. It doesn't move, not that week, not that month, maybe not at all. So you call your loan officer, a little annoyed, and ask the obvious question. I thought the Fed just cut rates. And they tell you something that sounds like a contradiction. They did, but that's not really what sets your mortgage rate. That sentence right there, that's the whole video, because most people believe the Fed controls the price of their home loan. It doesn't, not directly. And understanding what actually does is the difference between waiting years for a rate that may never come and making a clear-eyed decision today. This is educational content, not financial advice. Think of it as understanding the machine, not a prediction. Here's the mistake almost everyone makes. They think there's one dial in Washington, and Jerome Powell turns it, and every interest rate in the country follows along behind it like ducklings. That's true for some rates. The Fed directly controls the overnight rate, what banks charge each other to borrow money for a single night. That's real, and it does ripple into things like credit cards and car loans fairly quickly. But your mortgage isn't priced off the overnight rate. It's priced off something much longer, the 10-year Treasury yield. And the 10-year isn't set by a committee in a room. It's set the same way anything else is priced, by supply and demand. Who's buying, who's selling, and how much new debt the government is issuing for people to buy in the first place. So here's the flip. The Fed can cut rates and the 10-year can barely move, because the 10-year isn't listening to the Fed. It's listening to a much bigger conversation happening between big, boring, institutional buyers all over the world. And for the last 30 years, one of the biggest voices in that conversation didn't come from Wall Street. It came from Tokyo. In the early 1990s, Japan's economy hit a wall. Real estate and stocks collapsed, and Japan spent the next 3 decades in what's now called the lost decades. Barely any growth, barely any inflation. To fight it, the Bank of Japan did something almost nobody else in the world had done. They pushed interest rates to zero. And when that wasn't enough, they pushed them below zero. Now, if you're a Japanese pension fund or an insurance company sitting on a mountain of cash, and your own government's bonds pay you basically nothing, you have 2 choices. Accept no return at all or go looking somewhere else. Japan chose somewhere else. For decades, Japanese institutions borrowed cheaply at home and bought assets abroad, and one of their favorite places to put that money was right here, in U.S. government debt. Japan has been for years the largest single foreign holder of U.S. treasuries, something in the neighborhood of $1.2 trillion as of the most recent data. That's not a rumor, that's not a guess. That's one of the most consistent, price-insensitive buyers of American debt the bond market has had for a generation. Think of it like this. Imagine one customer walks into the same store every single week and buys whatever's on the shelf, no matter the price. The store gets used to that customer. It plans around them. Japan was that customer, but that customer has been changing their behavior. In March of 2024, the Bank of Japan did something it hadn't done in 17 years. It raised interest rates. Then it raised them again, and it's kept going since. As of the middle of this year, Japan's policy rate sits at 1%, the highest it's been since 1995. That might not sound dramatic. 1% is still low by almost any other country's standards, but relative to zero, for institutions that had spent 30 years borrowing at zero, this changes the math completely. When Japanese rates rise, 2 things get more expensive at the same time. Borrowing yen gets more expensive, and hedging the currency risk on money sent overseas gets more expensive too. The free money isn't free anymore. And when the free money stops being free, some of that money starts heading home. That's called repatriation, and it's the quiet undercurrent behind a story most people never connect to their own mortgage. Here's the actual data point, and I want to be precise about this one. On August 5, 2024, After Japan's second rate hike that year, Japan's Nikkei 225 dropped over 12% in a single day, its worst day since 1987. The S&P 500 fell as well, around 3% that same day. Different scale, same shockwave, and it happened because global markets got a preview of what it looks like when this quiet buyer story becomes a loud one. Now I want to hedge this clearly because it matters. Japan hasn't stopped buying U.S. debt, and nobody can predict exactly how far this goes. But the pace of that buying and the incentive behind it has genuinely shifted. That shift alone is enough to matter. So here's the part that brings this back to your actual mortgage rate. The U.S. government has to issue an enormous amount of new debt every year, trillions of dollars worth, just to keep functioning. Somebody has to buy all of that debt. When one of your biggest, most reliable buyers becomes a little less reliable, the price has to do something to attract new buyers instead. And in a bond market, price and yield move opposite directions. So less demand, all else equal, means higher yields on the exact same 10-year treasury that your mortgage rate is anchored to. This is why you can have a headline that says Fed cuts rates and a mortgage rate that doesn't budge. The Fed is turning the small lever. The 10-year is being pulled by a much bigger one, global demand for U.S. debt, and Japan has historically been one of the strongest hands on that lever. I want to be careful here because this is not a guarantee of anything. Rates could still fall for other reasons, and nobody, including me, can promise you where mortgage rates will be next year. But understanding which lever actually moves your rate changes how you plan. Waiting indefinitely for the Fed to fix it isn't a strategy. Understanding the real mechanism is. So the next time you see a headline that says the Fed just cut rates, I want you to ask a different question. Not when will my rate drop, but who's actually buying the debt that sets my rate, and are they still showing up? Because the biggest risks in your financial life are rarely the loud ones. They're not the headline on your phone. They're the quiet ones, the ones happening in a bond auction on the other side of the world that eventually, slowly, show up in a number on your own mortgage statement. Understanding the real lever won't make the rate drop any faster, but it will stop you from waiting on the wrong one. I'll see you in the next